Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The subject today is the definitive agreement for Clearwater Analytics Holdings, that's CWAN, to be acquired by a private equity consortium. Primera and Warburg Pincus are leading it. It's an all-cash deal valued at about $8.4 billion, which comes out to $24.55 per share.
And what really jumped out was the market's reaction, the conviction.
Absolutely. On the first day of trading after the announcement, December 22nd, 2025, CWAN closes at $24.06. But critically, that happened on a volume of 91.1 million shares. I mean, to put that in perspective, that is nearly 15 times the daily average.
A huge number.
It is, and that high conviction price action brings us to our central question today. Did that $24.55 price efficiently capture the company's real intrinsic value? Did it crystallize wealth for shareholders after a period of, market inefficiency? I argue that it did. The tight arbitrage spread, the overwhelming volume. It's all validation that the market saw this offer as fair and, more importantly, certain.
I come at it from a completely different angle. While I agree that high volume suggests institutional confidence that the deal will close, I absolutely contend it does not value the price. To me, this acquisition is an opportunistic maneuver. It's a classic boomerang by the incumbent sponsors. They are harvesting future value at a price that I think fundamentally undervalues a best-in-class SaaS asset. They're exploiting a temporary market panic and the company's own structural complexity to pull off what is essentially a highly organized smash and grab.
Okay, but let's focus on the efficiency argument first. This offer, it provides an immediate and substantial 47% premium over the undisturbed share price of $16.69. That was just recorded a few weeks earlier, November 10th. This transaction is the ultimate execution against a clear market dislocation. CDAN wasn't trading low because its performance was bad. Its fundamentals are undeniably robust. It was trading low because of this pervasive AI displacement discount. Investors were scared, that generative AI would eventually just commoditize the complex data reconciliation workflows that CDAN specializes in. So the consortium stepped into that fear, offered a price that immediately wiped out that discount, and gave shareholders instant guaranteed cash certainty. And we just can't overstate the importance of the closing action. The gap between the closing price, $24.06, and the offer price, $24.55, is just 49 cents. That results in an annualized arbitrage spread of only about 4%. 4%. For a merger, that's basically a money market rate for risk. That extremely tight spread tells a very sophisticated story. The institutional risk arbitrage community is assigning a near 95% probability of a successful close. That completely negates any claim that the price is deeply undervalued or that the deal is at high risk of falling apart. The market has spoken, and it's spoken definitively on deal certainty.
That is a compelling argument, but I would frame the reason for that certainty very differently. The $24.55 offer is optically, and I'd say mathematically, lower than what a high-growth, high-retention SaaS asset should command. Let's just look at the metrics the market should care about. 24% revenue growth, 98% gross retention, and 35.5% adjusted EBITDA margins. This isn't some struggling company. This is a highly defensible, sticky platform that should command a valuation much closer to its 52-week high of $32. Instead, we're settling for an implied multiple of, around 17 times LTM revenue? I'm sorry, but I just don't buy that the market was so inefficient that this price, which is over $7 below its yearly peak, represents true long-term value. The real evidence of opportunism here, I think, lies in the identity of the buyers, Primera and Warburg Pincus. They guided CWAN to the public markets just a few years ago. The fact that they are now taking it private, the literal definition of a boomerang deal, it just confirms their conviction that the public market failed to grasp the company's long-term cash-generating power. They see value they created but couldn't realize publicly, and now they're capturing the necessary restructuring, whether it's aggressive offshoring or internal shifts in R&D focus, away from the short-term pressures of quarterly reporting. This isn't efficiency. This is the sponsors realizing they mispriced the IPO, and now they're correcting their mistake on the public shareholders' dime.
The notion of opportunism, though, needs to be rigorously tested against the structural realities of the transaction itself. While sponsors are indeed capitalizing on the AI fear, the price is defended not just by the market, but by the governance process.
But let's dive into the structural complexities, because they're the true enablers of this extraction. The Up-C corporate structure and its associated tax receivable agreement, the TRA. For most public Class A shareholders, that 2455 headline looks like a straightforward payout, but the Up-C structure introduces a critical and often very opaque contractual obligation.
It is complex.
To pay them 85% of the resulting tax savings back in cash. So in this take private, the $8.4 billion enterprise value headline, it incorporates the equity purchase price plus the lump sum settlement of that massive TRA liability. This accounting mechanism effectively diverts a significant portion of the acquisition capital, money that fundamentally flows from the acquirer's pocket, away from the public Class A shareholders and directly to the legacy sponsors. It makes the per-share price for the public float appear lower than the company's true worth to the acquirers. It's an exit strategy designed to favor insiders, and I find it deeply questionable whether a structure like that should even be allowed in companies seeking public investment.
Okay, I see why you find that structural argument compelling, but let me give you a different perspective on that complexity. While the TRA is, you're right, it is opaque, the sophisticated institutional market is certainly capable of pricing it in. And that tight arbitrage spread suggests these liabilities are already accounted for. But more importantly, your claim of extraction. It fails when measured against the corporate governance events leading up to the deal. The board was acutely aware of the potential for conflict presented by this boomerang dynamic. First, they executed a massive corporate simplification months before the proposal. They converted and retired the supervoting Class C and D shares. This successfully transitioned the company to a one-share, one-vote regime, aligning economic interests across all shareholder classes. That was, a prerequisite for legitimacy.
Sure, a necessary step.
And second, they went to extreme lengths to safeguard the process. The board formed a special committee composed entirely of independent and disinterested directors. This committee then engaged premier legal and financial advisors, Cravath for counsel and PJT Partners for the financial assessment. This deliberate cleansing mechanism is a crucial legal step in Delaware jurisprudence. It shifts the standard of judicial review from the rigorous entire fairness test, which puts the onus on the sponsors to prove the price is fair, to the far more differential business judgment rule. That procedural move is a massive victory for the board and the sponsors, legally insulating the price determination against the exact claims of opportunism you are presenting. Now let's pivot from the boardroom to the trading floor and look at the market mechanics that accompanied the news. The trading behavior, it speaks volumes about the conviction of large institutional players, not their panic. Fintel data shows an extraordinarily high off-exchange ratio of 61.19%. Nearly two-thirds of the trading volume was executed away from lit exchanges in dark pools.
Right. The ARBs moving in.
Exactly. In an M&A context, dark pools or alternative trading systems are the institutional way of buying without tipping your hand. Risk arbitrage funds use these platforms to execute massive buy orders for CWAN shares below the visible price, minimizing slippage and quietly accumulating the necessary float. This 61% ratio is the clear fingerprint of high conviction in a successful close. Furthermore, the high off-exchange short volume, 2.25 million shares, is often just a proxy for intense retail and long-side buying pressure being internalized by market makers. They satisfy the retail buy order by selling short, then they hedge the position. This mechanism facilitates liquidity and confirms that sophisticated capital is aggressively positioning itself for the certainty of the deal closing at 24.55.
Well, I acknowledge the aggressive arbitrage activity now, but that only confirms the deal is secure. What I find more critical is the pre-announcement activity, which suggests the stock was artificially constrained before the deal terms were even known. We saw a significant anomaly in FTDs, spiking to 287,769 shares on November 12th, Now that date is crucial. It's just 2 days after your undisturbed price, right before the stock started climbing on deal leaks. A spike in FTDs immediately preceding a merger announcement signals a liquidity hole. It suggests that short sellers, perhaps betting aggressively on the AI fear discount, were caught completely flat-footed by early informed institutional accumulation.
Okay, that's an interesting point on the FTDs.
The FTDs confirm that the stock was artificially pressed down and shorts struggled to settle their obligations as the float was quietly being soaked up in anticipation of a lucrative buyout. This anomaly, which indicates price manipulation before the announcement, coupled with the questionable optics of insiders including CFO James Cox and CEO Sandeep Sahai, selling stock in the low 20s shortly before agreeing to a $24.55 price, lends very strong credence to the theory that the public market was misled, structurally or psychologically, until the sponsors decided it was time to cash in.
I get that. But does a temporary settlement failure among short sellers truly invalidate the price discovery mechanism led by a special committee and PJT partners? Your focus is on pre-deal sentiment manipulation, whereas my focus is on post-deal certainty. The market, using real cash, has validated the $24.55 price.
But that market validation is incomplete yet. We have to address the optionality value inherent in the agreement, the go-shop period, which extends until January 23rd. The existence of a formidable, credible interloper, and we know that Thoma Bravo is a serious player here, fundamentally undermines the argument that $24.55 is the efficient final price. Thoma Bravo is known for its disciplined, industry-specific investment strategy in software, and its involvement sets a crucial soft floor under the stock. The go-shop period is an admission by the board that $24.55 might simply be the opening bid. Thoma Bravo's potential to return with a superior proposal, maybe $26, is real, and it suggests we should remain highly skeptical until that go-shop period expires without a competitive bid. We're trading a high-growth asset at 17 times LTM revenue, when a few dollars more would capture the true value.
But then why would the arbitrageurs price the deal so tightly if they believed Thoma Bravo had a legitimate shot at $26? I mean, if the market truly believed a bidding war was imminent, that spread would be significantly wider to account for the risk of a higher price failing or a potential regulatory snag. It's tight because the market has already factored in that optionality and demonstrably dismissed it. The Permira and Warburg Consortium possesses an intrinsic and powerful informational advantage: incumbency. They are the firms that previously owned the asset, guided it through the IPO. It is exceedingly difficult for an interloper like Thoma Bravo to find synergies, hidden value, or cost efficiencies that the current owners with their deep knowledge of the core architecture and customer base have missed. Incumbency creates a powerful, often insurmountable barrier. Moreover, if CWAN accepts a higher bid, they owe a break fee to the Premier Group.
That fee immediately increases the effective acquisition price that Thoma Bravo must pay, creating genuine financial friction against an escalating bidding war. All the evidence, governance, price action, competitive dynamics, it all points to a successful closing at or near the current $24.55 price, which I maintain is a rational conclusion to a period of market dislocation.
That may be true. The break fee adds friction, but that efficiency is exactly what's so frustrating to those who held through the AI fear. The process is structurally sound, but the outcome, it just feels like wealth extraction enabled by a momentary weakness in public valuation.
And I continue to maintain that the deal is the rational conclusion for shareholders who valued certainty over a volatile public market discount. So ultimately, we're left wrestling with the fundamental tensions surrounding this Clearwater Analytics acquisition. I focused on the immediate market validation, emphasizing the high closing certainty shown by the tight arbitrage spread and the massive volume. I also highlighted the defensive governance measures taken by the board, the independent special committee, external advisors, to ensure procedural fairness and legally safeguard the price determination.
And I, conversely, highlighted the structural reasons for possible undervaluation and the inherent opportunism. I focused on how the Up-C structure and the resulting TRA liability likely divert a portion of the enterprise value away from public shareholders. I also pointed to the opportunistic timing of this boomerang maneuver, using anomalies like the FTD spike as evidence that the stock was artificially constrained before the deal announcement, allowing the sponsors to capitalize on that AI discount.
We both fundamentally agree on the quality of the asset. I mean, CWAN's fundamentals with 24% growth and 98% retention are robust. And we both agree the public market suffered from a significant AI fear discount that depressed the valuation below what its metrics suggested.
Right. Our core disagreement remains whether the 24.55 price represents the necessary and efficient correction of that market failure, or whether it is fundamentally opportunistic wealth extraction enabled by structural complexity and the informational advantage held by the incumbent sponsors.
The immediate drama, of course, rests entirely on the low probability, high impact optionality of that go-shop period.
And regardless of the outcome of that period, the deal highlights a broader trend. High-quality SaaS assets, when they're facing short-term volatility or fear-driven discounts in the public market, are increasingly finding refuge in private hands to undergo necessary internal transformations and investments away from public scrutiny.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.